Hey guys, it is May from Markets with May, and it's actually been a really long time since I've done one of these. So it's weird because I'm almost a little nervous. Today, we are going to review the first quarter of AMC, the earnings call that just came out. It was a pretty good quarter, to be honest, but there are, as always, some things. For those of you that have never watched me before, my format is to always just go through what happened and then put stuff in the chats. I will always acknowledge in the chat. But I usually, because the way the screen goes, hey, Ethan, because the way that my screen works, I can't really see the comments while I'm presenting. But I have to give the disclosures. Past performance is not indicative of future returns. As you guys know, I own the stock. I have no options on it right now. And I own like 3 or 4 different types of bonds in varying degrees. So let's get into the numbers. It was such a good quarter. Okay, now some of you are going to be like, was it really a good quarter? And there are some things, okay? So it's not just that I am bullish all the time. That is like not my jam. But I do kind of just want to point out the things that were good. And in a lot of ways, remember, we're kind of trying to find the bottom, okay? No one is pretending like things are completely amazing at AMC. If someone is telling you that things are completely amazing at AMC, they are being a little bit, they're being a little bit too much, with all due respect, okay? But are things actually, how do I get rid of some of this stuff? Are things actually improving? Yeah. So here is the income statement. And thematically, the way to think about it is they held the line, okay? Because if we go through the statements, you'll see revenue was slightly lower than 2023. But you held the line more or less on operating loss, right? And you have this other expense benefit. Okay, so in parentheses, it's income. This is the note from that. There's some kind of settlement that paid the backseas, so to speak. And then last year, that wasn't the case. We had the exact opposite. So you add these two numbers together, and that's how you end up with a significantly better net loss. Okay, so is that good? Was that expected? How's that going? It would be considered good. And the reason it would be considered good is we kind of knew that this wasn't going to be the world's greatest quarter. And we knew that because there's a bunch of people, I'll give them full props because that's not quite the work I do, that follow these attendance numbers, that follow what's going on in the box aggressively. And so attendance being down 2.1% given a box that actually did not behave the way that it did in 2023 is a big deal. Okay. We all know that this is part of the actors' strike working its way through. It will be mostly done by next quarter. Let me just take this off for a second. It will be mostly done by next quarter, but it is not completely through the woods. We are done. Everything is cool right now because, you have to kind of like, the actor strike takes time. And so the movies are now coming out. It's usually like a 6-month lead time before movies are able to be edited and after they're filmed to even come through. So that's where we're at right now. Okay, moving right along though, there are some other things I really want to show you, which is very positive for how to think about it. Okay, so this right here, the fact that attendance was down, but you held the line is a big deal. The other income, whatever, that's awesome. Right now, you're just going to count every single thing that you can. You want to realize that they actually did this though on lower screens. Okay, so that's a big deal because a huge component of this call was about how much more profitable the company is. And I'm going to show it to you a couple ways, but this is actually the thing that you want to keep in the back of your head as you're thinking about how will they perform for second quarter and beyond. And that's going to be everything as to whether or not the debt gets paid back, what precisely is their leverage against debt holders that they will necessarily have to negotiate with. So this is the first part of it, which is understanding that the contribution margin per patron is higher. And they did not give these numbers in the past. I love how they're presenting them here. So we're talking about the fact that in general, you make about in the consolidated about 50 cents more per patron, 40 and change, whatever. Okay. And then in the US, you make quite a bit more International markets, a lot of this is FX, okay, and a lot of this is just the funkiness of the international markets. But overall, domestically, you're making more. Now, remember too, there's a lot more selling of stuff that's happened as relates to theaters, et cetera, that's going on internationally, okay? But in general, you make more. Okay, we're going to put a pin in that because we're going to have to come back to that. Also, you make more despite the fact that you have less screens. And some of that is movie tickets, which we will come back to, and some of that is the total. All right. Now, more on the screens. Okay. Now, when you look at cash flow, this is where the bears are going to get super aggressive, okay? The bears are going to get aggressive about the fact that you had negative free cash flow, which more or less looks in line with 2023. That's actually a big deal given how many fewer attendees you had and the fact that revenue came in lower. The fact that you're only like $1 million difference in free cash flow is a big deal. Okay. That should be considered good. The bears will do whatever the bears will do. I do want to show you this CapEx though. Okay. The fact that the CapEx was up like 3 million off of maintenance CapEx. All right. Let's talk about that for a second. Maintenance CapEx versus growth CapEx means that they are literally spending to try to keep these things, in good shape. Okay. And to be honest, if you're thinking about like, how do I match this to what is it like to like manage my own household? They're literally only fixing the stuff that needs to be fixed. They are not growing right now and they're not doing additional stuff because they know they've got to hold the line and have the strongest possible position going into debt renegotiation, which we all know is actively happening right now as we speak. And so I'm super cool with this, but I do want to indicate that when you see maintenance CapEx up like this, when you see this number go from 47 to 50, or excuse me, 19 to 28, that's like a pretty hefty increase. It does tell you that you can't keep putting duct tape upon stuff. There will be, as we get through some of this, especially as soon as you can renegotiate some of that debt, there will be improvements. Now, the good side of those improvements is the fact that he was very crisp on the call and talking about how much the improvements benefit earnings per share, benefit free cash flow, benefit and make the company more profitable. So that's a big deal. And we'll go through some of the one-liners, but he said something like they did 100-something closures and they opened 60 new. So netted out at around, quite a lot of, they netted out with a negative theater count. But the 60 that they opened actually make more than all of the theaters combined that they closed, which is kind of a big deal since it sounded almost like there were 2x theaters closed versus opened. Okay, corporate borrowings. This is everything for why everybody on the internet is all freaked out. Why isn't he applying the cash to debt? Why isn't he applying it? It's because of this free cash flow burn. This is a cash burn, okay? So because he's burning capital still, he cannot be just willy-nilly using his cash. It will put him in such a weak position relative to the debt holders to renegotiate it. So this came down 260 million-ish, okay? It's a big number. It's in line with the cash burn more or less. Plus, if you throw in some CapEx and then you had some other stuff here and there, this is fine. This is the right number, okay? So that's where we're at. There was a little bit of finance lease pay down. You did have a little debt that was improved. So 17.5 million aggregate principals swapped out for Class A common shares. Okay. And then I think there was a one-liner on some single-digit millions in lease payback. That's fine. And then he raised this. Okay, a couple of things that are also going to be on the bears' mind because a lot of them are probably eyeing the NYSE rule for getting close to $1 and what that means for delisting and what that might imply for the stock as far as like having to reverse split or what have you. They're really close to the line. Quite frankly, it kind of freaks me out too. I want you to understand that when you're reading these numbers, you can't really go by EPS. Even I would not try to be like, 62 cents versus $100.71 loss, so much better, because you do actually have a change in share count. So you really want to look at the net income, or in this case, net loss numbers to get a sense for how much better the quarter was than last year. And that's despite the fact that attendance wasn't equivalent to last year. Okay. So that's the first thing. The bears will be all over that. And then I do want to, when you look at these debt numbers, there will always be the question of second quarter, because on the call, he was so excited and so positive about next year and the latter part of this year, which from what he was seeing was going to be fantastic. So then it becomes a question like, all right, how bad is second quarter going to be? And he said, listen, second quarter is going to be pretty good, but we had kind of a bomb, amazing second quarter. So you need to realize that the comparable is it's a tough comparable, period. Okay. Now, he feels confident that he doesn't want to say the same thing about the third quarter and fourth quarter. And that's kind of a big deal. You definitely have seasonality in theaters. You definitely have the summers being stronger. So what I want to demonstrate to you, because there's other people that do this work, and I just wanted to like throw it out there to make it helpful for them so they don't have to look so hard on how to even think about it. If you are one of those that watches me but does your own independent box office work, what I want to show you is what they did last year. The numbers you're going to really want to be looking at to do your estimates, to derive your estimates, is this. Geez, why does it do this? It's so weird. Okay, so we're going to look at this, which is 2023. And this was the revenue from 2023. So even if they come in a little bit low relative to that, there was in the second quarter Q very specific information on what was made in the US, international markets, et cetera. And you can map that to what's provided on page 13 of the earnings release. So you'll see $12.19 versus $11.78. They make about 40 cents more per ticket. And we know that, even though you've got kind of a downtick relative to last year in food and beverage, we know that on a per patron basis, they're spending more. So it's a little bit of a funky number. And I say it that way because, quite frankly, if you go to F&B, you can kind of see that F&B barely shifted on the quarter, okay? So food and beverage is going to be around $8. That's no big deal, but it's really the ticket price. What's my point? My point is that if it comes close to this revenue number, you're probably going to be reasonably close to this in free cash flow, negative, okay? So we kind of have to just watch that very closely because this is what we have left in cash before we get to the other side of it. And he's saying that third quarter and fourth quarter looks to be really strong. Third quarter, fourth quarter last year was positive cash flow. So just realize, and then 2025 to him looks solid. 26 looks great, which is a pretty big statement given that you do have seasonality in those quarters. Okay, other things that just voiced over on the call. They lowered interest expense by $60 million per year, okay? So you can kind of see from the income statement, every quarter they're spending about 91. So you can multiply that by 4 and then subtract 60 from that. You're getting about $300 million interest expense if you do it that way. Okay, we still have a debt renegotiation come, so there is that. Bunch of new consumer products that they talked about. A lot of them are going to be great. Alcohol in New York is going to be upside to F&B going forward because, let's face it, New Yorkers drink. And then Q2 up against tough comps. This voiceover was probably one of the biggest ones that I heard, which is 15% of the profitability came from this new objectives that happened from last year. That's probably not in most people's estimates. Obviously, we have Billie Eilish that's happening. And then this was a very cool one too. They closed 60 theaters, and despite that, they had share gains. And that has to do with the CapEx to date. And then they did talk about debt, okay? And so, with the debt discussions, you know that they're going to be really focused on it, and that's going to be a big deal for the next quarter. So that's most of what I have prepared. Let's see if we've got any questions. Israel, Ethan already said hi. Thank you for stopping by. Give a little shout out here. Israel, always nice to have you on the show. Yeah, I mean, I think it's going to be kind of an interesting thing. The questions that I really wish they would have asked that they kind of didn't, which sucked, was they didn't really just clarify and voice over that you would get through the cash burn in the third quarter or the fourth quarter. That's kind of where we're going at. You're going to be really low on cash burn in the second quarter, or you got a shot at free cash flow positive if something really exciting happens that we don't know about. Like if you get, I mean, there just aren't that many Billie Eilishes. He said it on the call. That is true. That is what it is. MK, hello. How you doing? Thank you for stopping by. Oh, thank you. Maze and Bluetooth. What a cool name. I love some of these handles. You guys are so silly. What do I think are the okay? I love that you asked this question because I would have forgotten. So he talked about the fact that he's having a huge discussion with the bankers. In my dream world, if it is actually the case, because he did kind of say that the debt holders were open-minded, if they did a convertible note, that would be like my dream. Okay, so for people that don't totally understand why that would be my dream, it would do two things. Okay. The first thing it would do is it would be most likely at a lower rate than both the Odeon debt and the 2Ls that are 2006, or excuse me, 2026 that everybody is cuckoo for right now. And you guys that follow me on Twitter know that I have said over and over again that the convertible bond debt, if that's the solution, this would be amazing. Okay. The second thing that a convert does is that you can actually write in the convert the terms as relates to what would constitute convertibility into equity. So if you did that, then you'd have like a whole series of things that would have to be managed in the options market, and you would take kind of a 1 or 2 day immediate impact on the stock. Not so different from SoFi. So if you guys were like trying to figure out what it might look like, go look at how SoFi traded on the one day that it announced the convert, because you do have kind of a trading situation associated with that. So you'd have a 1 day impact, and then you would be done. Because anybody that has that convert that's going to roll that with is like, that's not how they're going to do the option. That's not how you would hedge a convert with volatility that's well over 100%. That would be really dangerous to do it that way. So you would most likely hedge it using, one of many methods that wouldn't incur such a ridiculous charge on the vol. Okay. So and also because the shares would not come up until after certain targets that the stock made, you wouldn't be able to lend those shares. So it would be a form of dilution that didn't create dilution in the form of more shares that could then be lent out. So sorry if that was a long explanation. I've tried to talk about it before, and hopefully that clarified it. If not, just keep asking questions. All good. Is Adam going to dilute me into the ground again? Jake, I can't really, I don't know the answer to this. Okay. Is there a chance of dilution? Yeah, there's still that ATM that is available. Is he going to do it at $3? Well, I think if he was going to do it at $3, he already would have done it. But you never know, because it really depends on what the cash burn is. And that's why I would have loved for him to just say the words, the cash burn from here should be done by this, and I have estimates of this for next quarter. But of course, he's not going to say that on the call, which drives me insane. He didn't really give guidance. It's the worst, right? So if your cash burn does go down to what I showed you was the second quarter of 2020, and you do get a reasonable progress made on what's going to happen with the 2026 debt, then you got a shot at having minimal additional equity issuance if he was serious about the fact that the third quarter, fourth quarter, and so on and so forth starts to get you into cash flow positive. Recall as well that if you go back to pre-COVID, you had a less profitable company, and yeah, you had stellar attendance and you had a box closer to 10 billion, 11 billion. He's saying like you get the same numbers at about 10.5 billion. That was from the last quarter call. But if you got back there, you do have a company that throws off 300 million in free cash flow. So or excuse me, it would be 300 million if you take operating income and use the capex cap that he told you about last quarter, which would be 250 million. So you made about 600 million. You subtract 250 from that, and so you have a nice, happy little free cash flow throw off that you could pay back debt with. And if that happened, okay, like if 2025 starts to look like an $11 billion box, there's almost no way that the debt doesn't get refinanced, and you do have some ability to start talking that talk in the third and fourth quarter. That's why when people have posted on my Twitter, May, should we be really worried that he hasn't done the equity exchange? He hasn't fully diluted at this point. I'm like, technically the smarter thing would be to wait until the third or fourth quarter when you have greater visibility on the films that are coming out and what the profitability might look like. So hopefully that clarifies. Again, sorry for short answer long, but hopefully that's helpful. Ethan, I think that's what you were responding to. How How are you doing? Do you think AMC will hire this year? Okay, Mohammed, you know I can't give investment advice. So there is that. And I'm kind of long-term holder. So for me, I just try to make sure I have enough cash and then just keep buying it. I am not done buying it because I do think we still have a bit of a volatile period. And I think the volatility is going to come from the fact that you're in such close proximity to the NYSE trading rule. So I could see people taking a shot at it. And you'll need people to basically come in and try to support the stock if that's the case. Realizing depending on how they precisely take care of the debt issue, whether and what it is it just a terming out of debt at a high rate combined with a reduction of debt? Is it because, and you could actually just term the debt out because that rate isn't so great. So what you'd need if they were going to term the debt out is ideally you'd still wait for rates to look clear as relates to the decrease from the Fed. So number one, you'd wait for that. Number two, if you could get a better sense for what your free cash flow is post 2025, you would do that. I have no idea why there's balloons on my thing. So sorry about that. I don't know what happened with the balloons, but there it is. Anyways, that's what you would wait for if you were just to term it out, you take no dilution further. If you do a convert, by definition, that is a dilutive impact, but it might not have the same technical impact on the stock because the shares wouldn't come up for borrow. Okay. So hopefully that long, short answer, again, sorry, clarifies it. I'll give Adam a good idea what his shares will actually be. Okay. Ethan, I think, has a couple of things. So what determines what the notes convert at? Okay, this is always negotiated by the debt side. They would set in the covenants exactly the terms of what converts the stock. It's always going to be the price of a stock. And if they like you, it'll probably be much higher because they're trying to support the stock at a higher price versus converting at a lower price. But it kind of depends on what they negotiate and how they're thinking about how things should play out. So hopefully that helps. You're saying they set those terms. Yeah, this is just negotiated between because right now you've got people on you've got the 2Ls that have to be paid back in 2026. So they would it's probably them that would have to decide one way or the other, but there could be another set randomly of folks that are interested in helping a girl out, so to speak, that would do something financially engineered, because the debt doesn't trade at 100, so there might be a way that you would do it that would be structured funky. That's beyond my deal, by the way. That really is, the reason my answer isn't so direct is because you've got a couple of different pieces, and this is actually, in my mind, advanced investment banking. Okay, you've got the fact that the debt is actually trading at a discount to 100 that's fairly significant. You've got different structures that you could potentially use. You do have some cash, and then you do have some potential for a much higher free cash flow in 2025. So that's beyond me, because you guys know I don't even post estimates or do anything like that. That's really a banker's question. Okay. So, but if you are like a banker watching this or some kind of super nerd, those would be the types of nuggets that I'd be trying to understand and looking for. I peed in Kenny's pool. I just have to acknowledge you because your name is so funny. Thanks for stopping by. Is it my birthday? No, my birthday is not till June, even though my name is May. When Moon, Jeffrey, when Moon, hello. Don't know when the moon is, but you guys know that I'm not the MOAS type of person. So this is going to be something that those guys do. But I'm rooting for you on that, because that would obviously take a lot of pressure off. How is my skin so clear? That is a combination of really good makeup, and I think there's a filter on my Zoom thing that I'm using. So it's not AI. It's not full on AI. I do sometimes use correction software, but I'm using Restream.io, and I think they apply a nice little filter to make me look a little better. So hey, girl's got to cheat where she can. Okay, cool. My birthday's very close to yours. Very, very cool. And I think that's everybody. Thank you guys so much for coming. If you're watching this on replay because you went to go see the premiere of Planet of the Apes, then just put your questions below. And then follow me on, really, I'm not doing that much on Instagram these days as far as the Markets with May thing goes, but I will at some point pick it back up. Please follow me on Twitter, or X, I guess, as they're calling it now. And good luck, everybody, with your investments. I will try to do more videos, but I do have this crazy summer and I kind of just want to have fun, to be fair. But bye, guys.